Welcome to Columbia University's World Leaders Forum. This evening, we will be hearing from Federal Reserve Governor Daniel K. Tarullo, whose address is titled Unemployment, the Labor Market, and the Economy. I also want to recognize the Program for Economic Research and Columbia's Department of Economics, both of whom are major partners in this event. We come together at a moment in our history when a lot of people are understandably preoccupied by what's happening on Wall Street, which these days is less a place than a metaphor for what's happening all across a truly global financial system that exists more in the digital cloud than in lower Manhattan. While the trends in global finance that have led to ever greater volatility of markets and ever greater inequality of income are by no means new, they have certainly come to a painful crescendo since the middle of 2008, when the whole system was in danger of collapse. That it was not allowed to do so surely saved the United States and the global economy from an even worse fate than what we've experienced in the past 3 years. But as we know all too well, that is cold comfort to millions and millions of people, businesses, organizations, and governments whose prospects have been damaged by what had become a broadly misplaced faith that markets are rational, self-efficient, and self-correcting. We all know better now. Even Alan Greenspan has said he knows better. Yet every one of us and every institutional sector of the society, including those of us in the academy, has to ask ourselves, how did we let things go so wrong? As someone especially interested in the essential role of a free press in a democratic society, I certainly must ask the question, why did our great news organizations fail to ensure that we knew better sooner? It may be true that the mass psychology of bubbles can never be popped by lonely skeptics or even by critical analysis alone. But the fact remains that even after the early warning shots of Enron and WorldCom, much of our press missed the biggest financial story of our era. I cannot pretend, do not pretend to have a good answer as to why. It is natural, of course, for people to ask, and certainly the public focus in the past 3 years has turned to asking just who is responsible. We're providing answers of all kinds. Some say it was the bankers, some say big government, some say the liberals, some say conservatives, some say the mortgage industry, some say irresponsible borrowers, some say too little regulation, and astonishingly to me, some say too much regulation. Some say it was the rating agencies, some say it was the quant's black swan. Some say it was the Federal Reserve System. Now, for those of us at Columbia, once Alexander Hamilton's college, we understand that the framers of the Constitution believed it was essential to create a strong federal government that could both take on and be responsible for paying a national debt. But just as the early federal era's Bank of the United States became a political lightning rod, so has today's Fed, both for its extraordinary efforts to help stabilize our financial system when it was in crisis, and for its more recent efforts under Chairman Ben Bernanke to help encourage liquidity and to prompt economic growth. But the Fed's powers at this point are small in comparison to the issues we face. Getting back to normal simply cannot reasonably be the goal. Where we are today screams out for a large, bold vision of what kind of society and what kind of world we want, what kind of people we want to be. A future, therefore, that only tries to reclaim the past is likely to be fairly dismal. New ideas, new ambitions, new understandings about who we are and what we stand for are called for. It is for this reason that I am especially pleased that we have Dan Tarullo with us tonight. He has had a truly admirable career in public service and legal scholarship. He is a tenured faculty member of the Georgetown University Law Center, where he teaches international economics, regulation, international law, and banking law. Of course, he serves as a member of the Fed Board of Governors, now appointed by President Obama. During the Clinton administration, he served successively as Assistant Secretary of State for Economic and Business Affairs and Deputy Assistant to the President for Economic Policy, as well as the President's personal representative to the G7, G8 group of industrialized nations. From 1981 to 1987, he was a faculty member at Harvard, where he authored an influential piece arguing that American workers displaced by trade pacts should be entitled to compensation and to help in seeking training for new work. Dan has said, quote, "We need to do more than just adjust our regulatory system. We really need to redesign the system, but in doing so to draw on the regulatory tools that have developed over the years." He has also said that the government must seize the momentum for reform, which all will eventually attenuate because people's attentions turns to other things. But at the present, while many question whether the reforms to date have been enough to make our economy more productive, our financial markets more stable, and our society more fair, it does not appear that people's attention is turning anywhere anytime soon. It's very fortunate for us to have him here. I think one of his personal background notes I would point to is that he was a student at the University of Michigan when I just became a law professor at age 27. I always feel that people who took any class I taught at that time should have their money back. And he was on the Law Review, edited one of my first pieces. So I have a real close feeling to Dan, for Dan. And it's also, I was in Washington at a meeting at the Fed last June, and Dan said that he had been thinking hard about the issue of jobs and employment and unemployment, very, very concerned about how people were thinking about it, and he wanted to deliver a major talk on this. And would we be interested at Columbia in having that? I said, absolutely, and that's how this happens tonight. Dan, thank you for being here.
Thank you, Lee. So President Bollinger alluded to regulatory issues, and as some of you may know, I'm associated more with regulatory issues. It was the area that I was teaching in. I'm the oversight governor at the Fed for regulation. And I do spend an awful lot of my time, both publicly and in my day-to-day work, thinking about and trying to effect an overhaul of the financial regulatory system so as to avoid the kinds of problems and crises that we had over the last few years. But tonight, I'm not going to talk about the origins, the problems in the financial system, the excesses, and what needs to be changed. I'm going to talk about what has happened in the aftermath of the financial crisis. And so I want to talk about the American economy in general, but in particular the employment situation. Now, I'm mindful of the trend of public discourse towards hyperbole, so I hesitated in deciding whether to characterize that situation as a crisis. But it is hard to justify characterizing in any less urgent fashion the circumstances of the nearly 30 million Americans who are either officially unemployed, out of the labor force but wanting jobs, or involuntarily working only part-time. This situation reflects acute problems in labor markets created by the financial crisis and by the recession that followed. But we also confront chronic labor market problems. In my remarks this evening, I will outline both sets of problems, but in my observations on policy responses, I'm going to limit myself to the acute problems, in part to join the debate on their origins, in part because they call for the most immediate response, and in part because they're most relevant to my monetary policy responsibilities as a member of the Federal Open Market Committee of the Federal Reserve. That said, I hope you will not think the chronic problems any the less important for the briefer treatment they receive tonight. Now, I'm in an academic institution. I used to teach in academic institutions, so I know what you do when you have students in the room. You say at the beginning what the 3 points are so that everybody can figure it out, write it down or type it down, and know where you're going in the rest of your remarks. So let me do that now. And I do have 3. First, the acute problems in the labor market are largely, though not completely, the result of a shortfall of aggregate demand following the financial crisis and recession. As such, they can be addressed through measures designed to increase total investment and consumption spending in the economy. Second, because the recession arose from a financial crisis, which itself followed a buildup of asset bubbles and unsustainable debt in important areas such as housing, the policies likely to be most effective at increasing aggregate demand may be somewhat different from those associated with a more typical recession, and even so are not likely to work as quickly. Third, if labor market conditions remain this unfavorable for a long period, the problems that I am describing as acute could transform into another chronic problem. I refer not just to the despair and desperation that workers and their families must feel as weeks of unemployment stretch into months and even years, which alone should be enough to elicit a policy response, but also to what occurs when the ranks of the unemployed remain so great for so long. The erosion of skills and labor market attachment may affect the productive capacity of the economy as a whole. So now let me start with some basic statistics that summarize the current state of the labor market. There's always a risk with statistics that they just start to go in one ear and out the other, but bear with me for a few minutes and I think you'll see the cumulative effect that these statistics have in painting the picture of the economy today. The most familiar, of course, is the unemployment rate, which, except for a couple of months earlier this year, has been at or above 9% since mid-2009. This is only the second time since the Great Depression that the jobless rate has been so high, and it is the first time since the 1930s that it has been so high for so long. Unemployment rates are exceptionally elevated for certain subgroups of the population. Nearly 15% for workers without a high school education, 16% among African Americans, about 25% among all teenagers, and nearly 50% for African American teenagers. Even among college graduates, whose unemployment rate is much lower than that of the population as a whole, the rate has doubled since the onset of the recession. As familiar as the unemployment rate is, both as a measure of economic slack and as an indicator of the pain experienced by American households, it does not tell the whole story. About 9 million workers who would like a full-time job can find only part-time work. Millions of others are working at jobs for which they are overqualified and likely earning less than in their previous jobs. Meanwhile, another 6 million people who are not officially counted among the unemployed say that they would like a job but have stopped looking for one, in many cases because they've become discouraged by the poor state of the labor market. This effect can also be seen in the labor force participation rate, which has dropped sharply since 2007. The proportion of the U.S. population that is employed now stands at about 58%, the lowest level since 1983. Finally, more than 6 million workers, nearly one-half of the unemployed, have been jobless for more than 6 months. The long-term unemployment rate is by far the highest it has been since the duration of unemployment began to be collected, the data on the duration of unemployment began to be collected in 1948. Even more dispiriting than this snapshot of the employment picture is that there is so little momentum toward improvements in labor market conditions. The level of payroll employment fell by nearly 9 million during and just after the recession. To date, only about 1/4 of that number of jobs has been restored. The pace of job growth in recent quarters has been barely enough to absorb the increase in the labor force and wholly insufficient to produce meaningful declines in unemployment. The number of new claims for unemployment insurance suggests only modest gains in employment in coming months, while measures of job vacancies seem recently to be trending down. Now, persistent employment weakness during an economic recovery, even a tepid one such as the one we're experiencing now, raises the important question whether it is symptomatic of longer-run changes in the labor market. Indeed, in some respects, the recent weakness resembles the so-called jobless recoveries that followed the 1990 and 2001 recessions. While there are some important differences between this recovery and the recoveries that followed those earlier recessions, there are also some discouraging long-term trends that show continuity during this period. Even before the recession, the labor market seemed to be on a slower trajectory than in previous decades. Between the business cycle peak in early 2001 and the peak in late 2007, the number of payroll jobs rose an average of only about 0.6% a year, compared to job growth of 1.8% per year, triple the level, in both the 1980s and 1990s. Similarly, the labor force participation rate and the percentage of the population employed peaked around 2000 and have been on a downward trend since. It is true that a good part of this change can be accounted for by demographic factors, notably lower population growth, the aging of the baby boom, and the leveling off of participation rates among women. But other more disquieting factors are also at work. Two tendencies in particular suggest that the U.S. labor market has lost some of the dynamism that had long contributed to its resilience. First, since the late 1990s, there has been a secular decline in job reallocation, which is an important part of the creative destruction that contributes to long-run economic growth. For example, as jobs shift from less productive firms to more productive firms. Second, the amount of employee movement across jobs has fallen over time. Specifically, the rate at which workers move from one firm to another has declined. So is the rate at which workers quit jobs, an indication of the degree to which they believe there are better jobs available for them elsewhere. In what may be a related trend, geographic mobility across counties and states has also decreased. Longer-term patterns in the types of jobs being created have also contributed to a widening gap in wages and income between the richest and poorest Americans. Adjusting for inflation, earnings for a worker in the middle of the wage distribution have risen about 10% since 1980, while earnings for a highly paid worker at the 90th percentile have risen more than 30% during the same period. Earnings for workers near the low end of the distribution, those around the 10th percentile, have risen only about 5% after taking inflation into account. Thus, as has been widely observed, the gains from economic growth over the last 30 years have disproportionately accrued to the highest wage earners. To some degree, growing wage inequality reflects rising returns to education. Since 1980, the average wage for college graduates has increased from about 1.5 times the average wage for high school graduates to about 2 times their wage. The good news is that this rise has encouraged more young Americans to enroll in college. The bad news is that less educated adults with significant work experience and younger, inexperienced adults who are either ill-prepared for or unable to afford college may be increasingly excluded from future economic gains. This widening inequality has been described as the result of a broader trend toward occupational polarization. This theory posits that the diffusion of computer-related technologies, the related automation of routine work, and an increased capability for firms to offshore their activities have combined to concentrate job creation in the poles of either high-skill, high-wage work or low-skill, low-wage work. The high-skill occupations increasingly require at least a bachelor's degree. At the same time, demand has shifted away from traditional middle-class occupations. The kinds of workers who would have been employed in the past in manufacturing or administrative jobs now often end up in lower-paying jobs. Younger workers have historically filled many of these lower-paying service sector jobs that are now more likely to be taken by less educated adults. Thus, occupational polarization may be responsible for some of the rapid decline in employment and labor force participation among young people over the last decade. While part of this decline, again, is likely attributable to the pursuit of additional education, employment and participation rates have also fallen for those who are not attending school, suggesting that education-related explanations are not the whole story. Indeed, research by Federal Reserve Board staff has found that greater crowding out from adults can account for much of the decline in youth participation. This crowding out may have undesirable long-term consequences for the current generation of younger adults, as some research finds that poor job opportunities early in one's working life can lead to lower employment and wage rates in the future. To this point, I have portrayed a labor market still disabled by the trauma of the financial crisis and the recession that followed, but also beset by chronic maladies whose symptoms predate the crisis. In considering the nature and magnitude of appropriate policy responses, an important question is the extent to which the current high level of unemployment reflects a shortfall in aggregate demand rather than additional structural problems arising from the recession. If the high level of unemployment were predominantly structural, then the increase in aggregate demand intended by various monetary and fiscal policies would presumably be of limited efficacy. Although structural problems likely account for some of the high jobless rate, I believe the evidence points to aggregate demand as clearly the more important explanation. On its face, the sheer magnitude of the decline in the number of jobs during the recession, the speed of the increase in unemployment, and the halting nature of the economic recovery together create a fairly strong presumption that insufficient aggregate demand is the most important factor. Various arguments have been advanced in an effort to rebut the presumption that an aggregate demand shortfall accounts for much or most of the increase in unemployment. The most common argument is that the deep recession created serious difficulties in matching available workers to available jobs, resulting in a big increase in structural unemployment. The mismatches in question could develop for a number of reasons. First, some have suggested that the traditional willingness of American workers to move from weaker labor markets to stronger ones has been impeded by the sharp decline in residential property prices, and especially by the large number of mortgages that are now greater than the value of the property securing them. Those are the underwater mortgages. But research suggests that such house lock has probably not had more than a small effect on structural unemployment thus far, since migration declines during the recession have not been larger for homeowners than for renters. A second factor, the one most often cited in support of the structural unemployment hypothesis, is skills mismatch. Now, while it is quite plausible that certain features of the current labor market do reflect some skills mismatch, contributing to a rise in structural unemployment, closer examination reveals that they explain less of this increase than might first appear. One such labor market feature is the sharp reduction in employment in sectors related to the housing bubble, such as residential construction and some parts of financial services. The contention is that the skills of workers in these sectors do not readily transfer to other sectors, and thus they will have a particularly difficult time finding new jobs. But in every recession, certain industries and occupations are hit particularly hard, resulting in significant permanent job losses. Yet previous recessions do not seem to have been accompanied by notable increases in structural unemployment. And there is no evidence of which I am aware of new rigidities that would further hamper labor market adjustment today. Some have also pointed to the high level of long-term unemployment, which I mentioned earlier, as evidence that mismatch is a major factor keeping the unemployment rate high. The claim is that those without the skills sought by employers will take longer on average to find new employment. However, again, the data do not back this claim, at least to date. If high unemployment durations were the result of mismatch, the probability of finding a new job should have declined proportionally more for the long-term unemployed than for the recently unemployed. In fact, reemployment probabilities during the recession fell by similar amounts for all durations of unemployment and have edged up by similar increments in the recovery. Again, this pattern is more consistent with weak aggregate demand being the most important cause of high unemployment. Yet another argument for the structural unemployment hypothesis is that the relationship between job vacancies and unemployment has recently changed. Generally, job vacancies bear an inverse relationship to the unemployment rate. That is, when the unemployment rate is low, vacancies are relatively plentiful, and when unemployment is high, vacancies are scarce. The pattern of these changes over time has been plotted on what is commonly referred to as the Beveridge curve. Much has been made of the fact that the Beveridge curve appears to have shifted out in the last couple of years. That is, the number of vacancies has increased while the unemployment rate has dropped relatively little. The argument one hears is that the shift reflects an increase in job mismatch, with the vacancies going unfilled because of structural reasons such as lack of geographic mobility or appropriate skills. I think far too much has been made of this argument. In the first place, the Bureau of Labor Statistics data series from which the Beveridge curve is constructed began only in 2000, barely 10 years ago. Researchers who used other data sources to draw what we might call approximate Beveridge curves found that during and immediately after the serious recessions of the mid-70s and the early 80s, the curve also shifted out noticeably. But in both cases, it shifted back inwards during the recovery. Why this occurred is not so clear. The big increase in job losses during the recession is probably a factor, as sharp increases in layoffs overwhelm the matching process. In sum, I do not think arguments suggesting that structural factors account for most of the increase in unemployment are persuasive, either individually or collectively. Our efforts to quantify the increase in structural unemployment since the onset of the recession find that it accounts for less than a quarter of the difference between today's unemployment rate and that which prevailed in the pre-crisis years. Now, before leaving the subject, I want to mention a different version of the structural unemployment argument. This is the concern that high unemployment today will result in an increase in structural unemployment in the future, a form of the phenomenon known as hysteresis. The unusually long duration of unemployment spells and high fraction of the labor force unemployed for more than 6 months raise the prospect that the long-term unemployed will become progressively less employable as their skills, reputations, and networks deteriorate. In other words, the distinction between cyclical and structural unemployment could begin to blur. In the aggregate, such efforts could result in a persistently higher level of structural unemployment, a persistently lower rate of labor force participation, and a concomitant decline in the level of potential output of the entire economy. Whole cadres of workers, whether younger people leaving school at a time of high unemployment or older workers losing long-time jobs, might never regain the career trajectory on which they were headed. In the past, such effects do not appear to have been very significant in the United States, and there is little evidence that they have taken hold today. But the current unprecedented durations of unemployment may reduce the relevance of historical experience. Even if the rise in structural unemployment is relatively modest to date, the longer the labor market remains weak, the greater the risk that structural unemployment will become more of a problem. Of course, if anything, this variant on the structural unemployment argument argues for more aggressive policies to reduce unemployment sooner. Now, the policy issues presented by today's labor markets are challenging, to say the least. There is need and ample room for additional measures to increase aggregate demand, particularly in light of the limited upside risks to inflation over the medium term. Unlike in the aftermath of the steep recessions of the mid-70s and early 80s, demand growth has not become sufficiently self-sustaining to produce the strong recovery that followed those early episodes. Up until quite recently, the dominant metaphor one heard for the economy was that it was on its way to a healthy recovery, but was hitting occasional soft patches. This always seemed to me quite an optimistic reading of the data. Now I believe nearly everyone has toned down their expectations. I think the better metaphor is of an economy slogging through the mud and occasionally hitting stretches of dry pavement, which may well have been associated with the peak effects of fiscal and monetary policy initiatives. The economy's difficulty in gaining traction is, of course, due in no small part to the continued high levels of unemployment and underemployment, which constrain demand through both direct effects on household income and indirect effects as they sap consumer confidence. But it seems quite likely that there is something else at work beyond an adverse feedback loop involving personal consumption expenditures, investment, and employment. The obvious candidate for that additional factor is the high amount of debt, particularly household debt, that accumulated before the financial crisis. With the bursting of the housing bubble, debt levels that may have looked manageable to consumers who believed their homes were appreciating suddenly appeared burdensome as house prices declined. In some parts of the country, this decline was dizzyingly rapid. There has been some progress in working off or writing down some forms of debt, such as credit card balances. But housing continues to hang like an albatross around the necks of homeowners and the economy as a whole, with millions of underwater mortgages, a staggering inventory of foreclosed homes, and depressed levels of sales. What then are the policies best suited to increase aggregate demand? It must first be said that neither monetary nor fiscal policy will be able to fill the whole aggregate demand shortfall quickly. But appropriate policies could surely boost output and employment. As you probably know, the Federal Reserve has maintained the federal funds rate near zero for almost 3 years in response to the extraordinary economic and financial problems faced by the country. With short-term rates already about as low as they can go, the FOMC, the Federal Reserve, has also taken some unconventional measures to provide additional monetary accommodation. The combined effort of these monetary policies helped to stabilize financial markets in 2009, hold deflation at bay in 2010, and support a modest recovery. But in the absence of favorable developments in the coming months, there will be a strong case for additional measures. Some have argued that monetary policy should do no more, and that the political branches of government should adopt fiscal or other policies to encourage increased economic activity and job creation. I certainly don't disagree that well-conceived policies by other parts of the government could produce gains in employment, investment, and spending. But the absence of such policies cannot be an excuse for the Federal Reserve to ignore its own statutory mandate. The Federal Reserve Act requires that the FOMC promote the goals of maximum employment and stable prices. The statute does not qualify that mandate by saying that we should promote those goals only if all parts of the government, or for that matter, the private sector, are acting just the way we think that they should. In other words, we have to take the world as we find it and adjust our actions accordingly. There has been considerable discussion of possible additional accommodative measures. I believe we should move back up towards the top of the list of options, the large-scale purchase of additional mortgage-backed securities, or MBSs. something the FOMC did in November 2008 and again in March 2009 to provide greater support to mortgage lending and housing markets. A large-scale MBS purchase program has many of the benefits associated with purchases of longer-duration Treasury securities, such as inducing investors to shift to other assets, including bonds and equities. But it could also have more direct effects on the housing market. Even though nominal MBS rates have declined somewhat since the start of the year, spreads to Treasury yields have widened noticeably. By increasing demand for MBS, such a program should reduce the effective yield on those mortgage-backed securities, which in turn should put downward pressure on mortgage rates. The aggregate demand effect should be felt not just in new home purchases, but in the added purchasing power of existing homeowners who are able to refinance. Indeed, homeowners who refinance get the equivalent of a permanent tax cut. Now, I should note that the mortgage market is quite segmented. One relatively small group of homeowners has extremely good credit and funds for sizable down payments. That group can readily obtain a mortgage today. The other, larger group lacks one or both advantages, and it faces much greater hurdles in the mortgage market. So there is some chance that the principal effect of renewed MBS purchases would be to allow those in the first group who have already refinanced to do so again, or to buy a new home at a somewhat lower mortgage rate. These outcomes would be helpful, but the effectiveness of an MBS purchase program would be amplified, perhaps significantly, if certain non-monetary policies were changed. For example, action could be taken to bring the benefits of refinancing to underwater borrowers. Proposals for promoting refinancing have been made by many academics, legislators, and policy observers. Any of those that could sensibly and effectively be implemented would increase the impact of an MBS purchase program. Needless to say, though, an MBS purchase program, even were it to be adopted, would not cure all that ails the housing market, much less fill the whole aggregate demand shortfall. There is a host of other problems that would also have to be addressed. But I believe that MBS purchases are worth considering as a monetary policy option, precisely because they carry the promise of addressing the feature of the current aggregate demand shortfall that differs from typical recessions and recoveries. The labor market problems that I was talking about earlier took years to develop, and they won't be remedied quickly. The employment situation we hope for will require an extended commitment over many years. As I said earlier, I'm not even going to try to do justice to the longer-term employment policy agenda. It's easy to echo the nearly universal call for improvements to education, innovation and retraining, and other more effective labor market policies. It is harder to specify what those policies are, much less how to fund them. But I do want to emphasize that the challenge is more than determining which education and training policies are both effective and affordable. The nation needs a model for economic growth that will generate innovation and productivity enhancements that will in turn generate the kinds of jobs for which we hope we will educate and train our people. For much of the last decade, the implicit growth model was too heavily dependent on the assumption of ever-rising housing prices. That did not work out so well. Elements of the needed model include a healthy macroeconomic environment and a well-functioning financial system. But there should also be a premium on measures that expand the growth potential of the country, even as they support near-term economic activity. Even the acute problems reflected in today's grim employment picture cannot be reversed as quickly as in past recoveries, precisely because the recent recession arose from a financial crisis that was in turn the result of asset bubbles and high levels of unsustainable debt. But the fact that these problems cannot be resolved quickly does not mean there is nothing to be done. Indeed, without more, the harm to the unemployed and their families continues, and the risks of longer-term harm increase, both to the unemployed and to the country as a whole. A shortfall of aggregate demand is the most important factor behind these dismal statistics, particularly if we take account of the unusual nature of the current shortfall as we fashion policy responses. There is much that government policy, including monetary policy, can still do. Thank you very much.
Okay, we have two microphones, and we'll just go back and forth and begin with you.
Thank you for your most interesting talk. One of the things I don't think you mentioned with respect to the shortage of jobs, what is your opinion about the fact that so many jobs are sent overseas, thousands, and I don't know the statistics, but I know certain industries where this is commonplace, particularly the computer industry, programming and so on, and they just ship them out. How much would you account for the loss of jobs here due to shipping jobs out?
So I think that occupational polarization phenomenon or hypothesis that I was referring to actually rests in no small part on the offshoring phenomenon, which are also associated with capacity to routinize or computerize work. And I think that the labor economists who have done work in that area, who have sort of generated the occupational polarization hypothesis, would say that a non-trivial part of that polarization, or sort of hourglass nature of the jobs being created with the very highly skilled and the substantially less skilled, and the erosion of job creation in the middle, is in part attributable to the offshoring phenomenon, which really, right, is taking advantage of, in some cases, taking advantage presumably of growing markets abroad, but could also be taking advantage of lower labor costs sure. for things that can be fairly well routinized. So whatever one thinks about the macro effects of trade and the impact of trade and foreign investment, I think it's becoming increasingly apparent that the effects on the composition of jobs in the country has been affected in a meaningful fashion by both literal offshoring, but also the de facto offshoring that occurs as trade patterns shift.
Thank you.
Thank you for your speech. One of the factors that seems to be an important contributing factor to the global economic situation seems to be what we are seeing in Greece today. What do you think is the problem there? What are the potential solutions? And how would default of Greece affect the overall global economy, in your opinion?
Well, so I think that two things you need to keep in mind: two kinds of actual and potential costs. One kind of cost is just the cost associated with more stress in financial markets generally that results in some lessening of favorable financial market conditions, and that does have some more or less direct effects upon growth. And I think we've felt some of that here over the last several months as financial market stresses associated with the Eurozone situation have been felt. The second kind of phenomenon is more direct effects on the real economy here. So to the degree that the situation in Europe results in reduced economic growth, as a result of which Europeans are importing less from the United States and other parts of the world, then we will see that effect show up in our own GDP numbers. Obviously, if there were substantial financial problems in Europe which led to a substantial deterioration of real growth and a recession, that would inevitably have more of an effect on us and on the rest of the world because the real economy effects do transmit and transmit fairly quickly. Now, as to the solution, so the solution is obviously something that needs to be done by people in the Eurozone, and the efforts of the last several months, obviously, have been directed towards trying to achieve both the technical, legal, and political agreement as to how the kind of actions to stabilize the situation should be developed. I don't want to. I'm not in a position to know all of the interstices of what they are dealing with internally, so it's really not my place to comment, other than to say that I think, as many people in the United States have said, and as I think people in the Eurozone themselves understand, there is a need to come to grips with the problems associated with sovereign debt stresses and with the capital positions of banks, so as to hold at bay the kinds of negative possibilities that I talked about a few minutes ago.
Yes.
You mentioned that rates of geographic mobility are unaffected by home ownership. What, other than problems in the housing market, is contributing to the failure of people to take advantage of high vacancy rates in other areas?
So that, well, of course, let me say a couple of things about that. I spent a good bit of time. The beauty of agreeing to do a speech months in advance is you can actually take a fair amount of time to get to do lots of reading and have the Fed staff say, well, here are another 9 articles you might want to read this weekend. So we've had a chance to dig into a number of these areas. And the geographic mobility one is an interesting one because at this point, at least, I don't think people have a great answer to the question, why has there been a secular trend to reduce geographic mobility among workers? I think we do have a better sense of what is or is not going on in the short term, that is the period of the recession and thereafter. Which is that, so the thought was, gee, if people have underwater mortgages, they're not going to be able to sell the house, so they can't move to some place where there's a job. Well, as I detailed in the earliest part of my remarks, it's not like there are enormous numbers of jobs going unfilled around the country. So people's motivation to move in the first place might be even less than reflected in the secular trend. What we don't know, and will be interesting to see, is whether as job creation does pick up, when it does pick up, whether we will see an impact from people who do have some degree of house lock, assuming that those problems are not dealt with at the same time, or whether on the contrary they will find a way to return to the trend line. I think it wouldn't be a wild expectation to think that people with homes that have mortgages larger than the value of the home or close to it might well be impeded from moving. It's just that we haven't seen the effect of that yet, and I think that's because of the employment situation writ large.
Yes.
Thank you for your speech, Governor. During your talk, you framed your argument about policy mechanisms in a statistical and economic framework, but I'd like to ask you more about the intangible aspects of unemployment. There are millions of people out of jobs and who have lost homes, and many millions more who fear for their job security. And a lot of these people blame the Fed just as much as they blame financial institutions or rating agencies. And you only need to look at Occupy Wall Street or even the Tea Party to see this trend. So how does the Fed restore confidence and faith in itself and these institutions and the economic framework as a whole?
Well, so there's a certain paradox there, which I'm going to get to in a second. But first, let me begin by saying I want to differentiate between the origins of or the run-up to the crisis on the one hand and the response since the economy went into the serious recession that we experienced and have grown only modestly since. So let's go to the pre-crisis period. Now, I, of course, had the luxury of not being in the government, so one can be critical without particular consequences when one is outside the government. But I was critical of what I thought was, throughout the United States government, a wholly inadequate financial regulatory system. That's what I wrote about, that's what I taught about, and that's probably the number one policy issue that I was associated with in the years preceding my appointment to the Fed. So I would have no quarrel with anybody who would say that the regulators, including the Fed, let us down, and that the Gramm-Leach-Bliley Act did not provide the kind of regulatory framework that instructed the regulators to put together this strong system, so a strong regulatory system. So in that sense, yeah, government, including the Fed, I think really do have a measure of culpability. And those of us who have come in have a responsibility to change that regulatory system and to reshape it so as to avoid the kinds of stresses and excesses that we experienced before. Now, in terms of the response since then, that's where I say I think there's a certain paradox, because to a considerable extent, I mean, if you listen to the criticism of monetary policy, there is some criticism from those who think the Fed has done too little. But if I can characterize this, I think most of that criticism has been, sort of a prodding, urging, come on, we think we should do more. I would say that the more vocal criticism has probably been from those who don't think the Fed should have taken the actions that it's taken to try to increase aggregate demand, to bring down longer-term interest rates, to bring down mortgage rates. So that's why I say I think there's something of a paradox in the way that people are thinking about the role of the Fed right now. We have to make monetary policy, as I said. We have to take the world as we see it. If we see other parts of the government or just the economy performing in such a way as to substantially raise inflation risks, threatening that one side, the price stability side of the dual mandate, we have to act. If, on the other hand, we see an environment in which there's such a shortfall of aggregate demand, I believe it's our statutory responsibility also to act. And the reason why many countries in the world have moved towards more independence for central banks is they want the central bank to be, at least in a legal sense, insulated from the politics of the moment, able to do what is best for the economy of the country over the medium term. And it's the debate over what those measures should be, which is the centerpiece of what my colleagues and I do every 6 or 7 weeks in the FOMC.
Dan, could I ask on that? Because I think that really touches on an extremely important and interesting question of the sort of scope of authority or scope of powers of the Federal Reserve. And I was impressed by the way in which you said the sentence during your talk that the Fed has a statutory mandate and a real responsibility to try to reach full employment. And unemployment at 9% is a world that is unacceptable, and really something has to be done, and that's the Fed's mandate. So the question I think that one would pose is, what is the array of things that are possible within that mandate? Buying up things is one way to do it. Are there other programs? Are there things that the Fed could do given that statutory authority? obviously controlling inflation seems, this is not my field, but seems more straightforward. You just raise interest rates until people calm down. Dealing with unemployment is a lot of potential activities. Are there things that you would point to as possible that the Fed might employ to deal with this?
So this gets us back to the issue of normal times versus extraordinary times. So in normal times, monetary policy is not literally true, but in some practical sense it's close to true. That in normal times, monetary policy uses one policy instrument, which is changes in the federal funds rate. When, however, you're close to zero, obviously you can't reduce short-term interest rates any further. And that's what has us thinking about other mechanisms. I would say that broadly, there are two kinds of instruments that can be used by a central bank. One is balance sheet measures. That's the purchase of assets. Now, what we can purchase is limited by statute as well. We don't have free rein there. But the large-scale asset purchases of March of 2009 and November of 2010 are obviously the best examples of that. And the sort of option that I suggested tonight should be back on the table for reconsideration, would get us back to MBS purchases. The second kind of instrument is a communications instrument. Now, it may sound like not much of an communications. You say, well, speak more clearly, and there's merit in doing that. But the kinds of communication instruments that are potentially available are those which allow economic actors in general to understand better what the FOMC's intentions are and will be over some period of time. So when, for example, a couple of meetings ago, we indicated that given our assessment of the likely path of the economy, it seemed as though we would not feel the need to change interest rates until at least mid-2013. That was an example of an effort to use a communication strategy, and there are others which actually some members of the Columbia Law faculty economics faculty have articulated at some length, and other monetary policy economists do as well. Why do those work that way? Well, they work precisely because, or if they give assurance to potential borrowers that they can expect that this is going to be the prevailing attitude of the Fed, that as long as conditions continue as the FOMC projects, that there's not going to be a noticeable tightening. There's always going to be a contingency saying if they proceed as we expect. So I think there are lots of variations on both of those, but those really are the two basic instruments. And I guess, Lee, it's important to say in this regard or reiterate something I said in the remarks, which is the aggregate monetary policy can help with aggregate demand and thereby move us back closer to maximum employment more quickly than we otherwise would have. But it is not an instrument that can produce full employment on its own, and it's certainly not an instrument that will necessarily do so quickly. The point of a lot of what I tried to say was we can't take that as our standard. Are we going to solve all the problems by taking a step? That's not the way I read the statute.
Okay, a few more questions. Yes.
That was probably the perfect lead into my question. First of all, thank you for speaking with us and taking our questions. Many prominent academics have recently thrown their support behind using the Federal Reserve's communications policy to promote level targeting, or at least temporarily. Michael Woodford or Greg Mankiw, Paul Krugman, even President Evans. Any thoughts on using either targeting the price level or nominal GDP?
So I've learned, since being a central banker, I've learned that there are any number of times when you don't want to be too explicit in answering a question. But what I've also learned is it's better to say that at the outset rather than to give this long answer at the end of which everybody scratches their head and say, did he actually say anything? So I'm going to advertise my evasiveness on that only by saying that there are different frameworks to think about monetary policy. Nominal GDP targeting, price level targeting are two that are different from those we have now, which is basically a flexible inflation target. I think there is quite a bit of a sense among academics of different ideological orientations that perhaps the Fed should think about another framework for monetary policy. And speaking only for myself, I can say that I read all of this with great interest because just as we've got short-term and longer-term issues in the employment situation and the economy, I think we've also got them at the Fed. And so we need to, whether it's communications, how to make communications more effective, or is there a framework for monetary policy which in and of itself makes those communications more effective, are questions that I suspect both academic and other Fed observers on the one hand and we within the FOMC are going to be talking about for some time to come.
One more question then, please.
Hi. Joseph Holland, Columbia College. Regarding Operation Twist, given that interest rates are already at historically low levels, the 10-year at 2.2%, 30-year at 3.2%, what makes the Fed believe that attempting to push these interest rates marginally lower by a few tenths of a percentage point will have any tangible effect on the lack of consumer confidence and waning demand?
Well, so you're setting a very high hurdle. You're kind of doing the same thing that I tried to suggest is not really the right way to think about policy. If you say you need to, unless you can find a policy instrument that takes care of consumer confidence and employment and all the rest, then you shouldn't do it. And I don't think that's the way we think about policy. So what we did with the effort to, or the announced effort to change the way in which we were reinvesting proceeds was to have an effect upon rates that are out the yield curve somewhere. And since economics is very much an art and science that operates at the margin, something which produces a palpable marginal effect does seem to me, and I think seem to a majority of my colleagues, a step worth taking. Now, I for one, characterized it internally, and I would say the same thing externally, as a tool whose utility is almost by definition limited, because you can't keep doing it. You only have so many short-term things that you can dispose of, and so you can't keep doing what you've been doing. But I thought it was a useful step, something that at the margin can be helpful. And I think, based on the analysis that we've done internally, I think we've seen that it has had some effect. Has it solved all these problems? Is it the big answer? No, absolutely not. But again, I don't want to speak for my colleagues, but I certainly didn't think, and I don't think you can point to anything in the FOMC statement which suggests that we thought it would be.
Governor Tarullo, thank you so much for coming here, and we invite you back in a year to follow up on this. Thanks so much.
Thanks very much.